If your business cleared £150,000 in profit last year, ask yourself one practical question. How much of that did you actually keep? Between climbing UK corporation rates, dividend taxes on the money you draw out, and personal income tax, the government routinely collects more than half of your generated profit before it ever reaches your pocket. This chart compares a £150,000 profit block under the UK system to the UAE. The United Arab Emirates offers a different arithmetic, a 0% corporate tax rate on roughly the first $100,000 of profit and 9% on the remainder. That wide mathematical gap is exactly why thousands of business owners are attempting to relocate their operations overseas. The numbers are absolutely real, but the way most entrepreneurs try to execute this move accidentally creates a significant legal liability. This mistake often begins with an online ad promising a complete UAE company setup for £500. Founders fill out a quick web form, pay the fee, and assume they have secured a 0% tax rate. When their home country's tax authority eventually conducts an audit, these founders find they are still legally liable for their full domestic tax bill. A misunderstanding of modern international tax law turns these cheap, paper-based setups into a direct path to double taxation and severe fines. To understand why, you have to look at a concept called management and control. This is the primary metric that tax agencies actually scrutinize. HMRC doesn't care where your company is registered. They tax based on where the daily business decisions are made. If you run a UAE-registered company from a UK desk, that desk drags the legal reality with it. You're still running a UK entity. That oversight invalidates the 0% tax rate you thought you secured, subjecting every penny of your profit to full domestic taxation. The only way to move the tax border is to physically shift your management and control across international borders. A company's tax residency is defined by the physical geography of the human running it, not by the country printed on its registration forms. Legitimately securing the 0% rate requires establishing a verifiable physical presence in the UAE. That requires acquiring a residency visa, securing local operations, completing local medicals, and generating documentation of the time you spend in the country. You also have to open a physical UAE bank account to anchor all your company's financial operations locally. Building this structure runs roughly £6,000 to £8,500 in the first year, with annual renewals typically between £4,500 and £5,000. These costs establish a defensible audit trail. They provide the evidence required to withstand a formal compliance check from your home country. This graph tracks long-term structural costs. Compare the initial £8,500 setup against the cheap online form, and the financial difference is clear. The cheap form is a cost paid twice, once for setup and again in massive back taxes when the structure fails scrutiny. Weigh that £8,500 setup cost against the £50,000 or more routinely lost to domestic taxes every single year. This creates a clear break-even point. Past a certain revenue threshold, the cost of a physical relocation becomes small compared to the compound annual tax savings. The UAE residency setup operates as a high-return operational investment, provided the business is sufficiently profitable. This move is usually mathematically unviable if your business is still early stage or pre-revenue. It is built specifically for businesses generating six-figure profits, operated by founders who are genuinely willing to relocate their physical lives and operations. Tax codes are highly specific. Benefits like small business reliefs and exact thresholds change depending on your business type and the current tax year. Stop guessing your exposure based on generic advice. Book a consultation using the link below to map your exact numbers and find your current legal relief limits. It's time to determine if moving your management and control is your most profitable next move.